Welcome back to the Deep Dive. Today, we're going to take a look at, well, two companies you might not think have much in common at first glance.
Yeah, that's right.
We're talking about Walmart, the retail giant, and Realty Income,
Which is?
a real estate investment trust. But comparing these two side by side, I think, can reveal some interesting things about how to think about investing today. And maybe, just maybe, it can even help you figure out what kind of approach is better for your own money goals. What do you think?
Absolutely. I mean, what's so interesting here is that they seem, I don't know, like worlds apart.
Totally.
But when we dig a little deeper, we start to see how their fates are kind of tied together, and that can tell us a lot about these bigger trends we're seeing in the market.
Yeah, exactly. So let's start with Walmart. I mean, everybody knows Walmart, right?
Of course, yeah.
Huge company.
Huge.
A total retail powerhouse.
Yeah.
I mean, their market cap is massive, like $792 billion.
Yeah.
And on top of that, they've been doing really, really well lately. Like in Q3 of 2024, their revenue went up by 5.5%, and their earnings, their adjusted earnings jumped by almost 14%.
That's impressive.
It is, right. And especially when you think about how some of their competitors, like Target, are having a tougher time keeping up.
For sure. I think that says a lot about, Walmart's ability to adapt, right? Like they're figuring out how to do well in this kind of tricky retail environment. Think about all the changes with online shopping and how people are spending their money these days. It's not easy.
Definitely. And you can see their success reflected in their stock price too, right? Their price to earnings ratio, or PE ratio, is 39x right now.
Okay. And that means for folks who, maybe aren't as familiar with PE ratios, break that down a bit.
Yeah, sure. So basically, the PE ratio is like, it tells you how much investors are willing to pay for every dollar of the company's earnings.
Right.
So when you see a high PE ratio like Walmart has, it often means that investors are like really optimistic. They think the company's going to keep growing, and they're willing to pay a premium for the stock.
So it's like a vote of confidence from the market.
Exactly.
But of course, it also makes you wonder, right? Like, can Walmart keep this up? Are people maybe getting a little too excited? Like, is the stock maybe a little overvalued? These are the kinds of questions that investors need to think about.
For sure. Okay, so now let's switch gears. Let's talk about Realty Income. They're what's called a real estate investment trust, or REIT for short.
Right.
And their specialty is something called net leases.
Net leases, okay.
So basically, they own over 15,400 properties.
Okay.
And they lease them out to the single tenants, but on these really long-term contracts. And the really interesting part is that the tenant is actually the one who's responsible for most of the costs, like property taxes, insurance, all that stuff.
So Realty Income doesn't have to worry about that.
Exactly.
That's smart. So it's like built-in risk management.
Yeah. And then here's another interesting thing. Only 27% of their portfolio is actually retail.
Oh, so they're not just focused on stores.
Nope. They've got all kinds of things. Industrial properties, healthcare places, even vineyards.
Vineyards, huh? So they're not putting all their eggs in one basket.
Exactly, which is a pretty good move, especially these days with all the uncertainty in retail.
Makes sense. Diversifying, that's always a smart move when you're thinking about investments, especially for the long term.
Totally. Now, another really important thing to compare when we're looking at these two companies is their dividends, right? What they pay out to shareholders. So Walmart is actually what's known as a dividend king.
A dividend king, huh? That sounds pretty fancy. What does that mean?
Well, basically, it means they've increased their dividend payouts to shareholders for, get this, at least 50 years in a row.
Wow, 50 years.
Every single year.
They must be doing something right.
That's what makes them a dividend king, yeah. It shows a lot of stability. Like, they're committed to giving back to the people who own their stock.
So does that mean that, like, buying Walmart stock is a no-brainer then? Like, is it a guaranteed win?
Well, there's a bit of a trade-off. So, yeah, they've got this amazing track record with the dividend increases, but their current dividend yield is only 1%.
Okay, hold on. So what does that mean in plain English?
It means that for every $100 you invest, you'll only get back $1 in dividends each year.
Oh, I see. So it's not a huge immediate payout.
Right.
Okay, so what about Realty Income then? What's their dividend situation?
Well, Realty Income, they've got a really impressive 5.8% dividend yield.
5.8%. Whoa, that's way higher than Walmart.
Right. So for people who are really focused on getting that income from their investments, that makes Realty Income look pretty appealing. But the thing is, their dividend growth rate isn't usually as high as Walmart's.
So it's a classic trade-off. With Walmart, you're betting on that potential for big growth in the future, which could mean bigger dividends down the line. But with Realty Income, you're getting a bigger chunk of money right away, but maybe not as much growth over time.
Exactly. And of course, you can't forget the bigger picture. We have to think about things like interest rates and inflation too, because they can really shake things up, and not always in a good way. That's actually something I always tell people to check out, like the stuff on www.lokitools.net.
What's that?
It's a website from this group called L Impact Solutions. They've got these really in-depth analyses of companies, and then they look at all these different sustainability aspects of businesses.
Oh, wow, sustainability. So, like how a company impacts the environment and society and stuff.
Yeah, I
Interesting.
think it's super insightful,
Yeah.
especially if you're thinking about investing for the long haul. It's not just about the numbers, right?
Right. I totally agree. Understanding that bigger picture, like you said, it's really important these days, especially if you want to be a responsible investor.
So here we are. We've got these two very different companies, each one with its own strengths, and maybe some things that make them a bit riskier. What's the most important thing you think we've learned so far just from looking at these two?
That's a good question. I think the big takeaway is that there's no magic formula, right? There's no one right answer when it comes to investing.
Yeah.
It all depends on what you're trying to achieve, what you're comfortable with in terms of risk, and how long you plan on keeping your money invested. And of course, doing your research.
Couldn't have said it better myself. But speaking of the bigger picture, like we were just talking about, I think that's where we need to go next, right?
Yeah, let's do it.
We've got to explore those big external factors,
Yeah.
interest rates, inflation, and all that stuff, because they could really impact companies like Walmart and Realty Income, even though they go about things in such different ways.
Sounds good to me. I'm ready to dive in.
All right. Stay tuned for part 2 of this deep dive. We'll be right back after a short break.
All right, so we're back and ready to kind of zoom out a bit,
Okay.
We need to look at that bigger picture that we were talking about. It's not just about a company's numbers or how much they pay out in dividends, right?
Right.
We got to understand all those things happening out there in the world that can really, change the game for businesses.
It's like, how sometimes you check the weather and it says it's going to be sunny,
Yeah.
but then, bam, a thunderstorm rolls in out of nowhere.
Totally. You can never predict everything.
And that's kind of how it is with the economy, right? There are always these unpredictable things that can pop up and really mess with a company's plans, no matter how good they are.
Exactly. I mean, in the financial world, those surprises could be anything. Interest rates going up, inflation going crazy, or even people just suddenly changing their minds about what they want to buy. And all of that stuff can really impact companies like Walmart and Realty Income, even though they're such different businesses.
Okay, so let's break it down a bit. Let's start with interest rates. We've all been hearing about the Fed raising rates, but what does that actually mean for companies, especially for ones like Walmart that need money to grow, and Realty Income who are out there buying up property?
Well, when interest rates go up, it just means that borrowing money gets more expensive.
Yeah.
And that can really hit a company like Walmart because they might need to borrow money to open new stores or invest in new technology, or even just to manage all the stuff they've got to keep in their warehouses. When those interest payments go up, it eats into their profits, and that can slow down their growth.
Ah, so it's like putting on the brakes a little bit.
Kinda, yeah.
No.
Makes it harder to keep that momentum going.
And what about Realty Income? How does this whole interest rate thing affect them, since they're all about buying properties?
Well, Realty Income also borrows money to buy those properties, right? So higher interest rates mean that those purchases get more expensive, which could hurt their profits too. But, they do have a little bit of an advantage because of that net lease model we talked about.
Oh, right, because their tenants are the ones paying for most of the operating costs. So Realty Income is kind of protected from some of that inflation pressure.
Exactly.
Speaking of inflation, man, that's been a wild ride lately, huh?
Tell me about it. Prices are going up everywhere, and that affects everyone. People, businesses, you name it.
Yeah, like my grocery bill is insane these days.
Same here. But let's talk about how all this inflation stuff impacts companies like Walmart and Realty Income. How do they deal with it?
Yeah, I'm curious about that too.
So for Walmart, it's a mixed bag. On the one hand, they can kind of pass some of those higher costs on to shoppers by raising their prices, right? But on the other hand, if those prices get too high, people might start cutting back on their spending, and that could really hurt Walmart's sales.
Yeah, it's a tough balancing act for sure.
Exactly. They've got to find that sweet spot where they can keep their profits up without scaring away their customers.
Makes sense.
Okay.
So that's Walmart. What about Realty Income? How does inflation hit them?
Well, actually, inflation can be kind of good for realty income, at least for a while. Remember those long-term leases we were talking about?
Yeah.
A lot of those leases have these built-in rent increases that are tied to inflation.
Oh, so as inflation goes up, their rent goes up too.
You got it. It's like a built-in protection system that can make realty income a more attractive option for investors, especially those who are looking for that steady income, even when inflation is going crazy.
That's pretty smart. But I guess even with those protections, if inflation stays high for a long time, it can still eat away at the value of those future rent payments, right? And wouldn't that eventually hurt Realty Income stock price?
That's a good point. You're right. Nothing's foolproof, right? That's actually why I think resources like www.lokitools.net can be so valuable for investors. They really dig deep into these companies, looking at all these different factors, like how well a company can handle inflation. And that can be really helpful when things are uncertain like they are now.
Yeah, totally.
Yeah.
It's like a reminder that even investments that seem super safe can still be affected by all this stuff happening in the economy.
Absolutely.
Okay, so we've talked about interest rates and inflation. Is there anything else we need to think about when we're looking at this bigger picture?
Oh, yeah. One more big one. How people are feeling about the economy. That whole consumer sentiment thing. Like, are people feeling optimistic or are they worried about what's coming next?
Right.
That can really impact companies like Walmart and Realty Income. Well, think about it. When people are feeling good about the economy, they tend to spend more freely, right? And that's great news for retailers like Walmart. But if everyone's starting to get nervous, if they're worried about losing their jobs or if they think a recession is coming, they're going to tighten their belts and cut back on their spending.
Makes sense.
And that could lead to lower sales for retailers, which could then impact realty income. Because if those stores aren't making money, they might not be able to pay their rent, or they might even go out of business.
Whoa, it's like a domino effect.
Exactly. And that brings us back to that idea of interconnectedness we talked about before, right? Businesses don't exist in a bubble. They're all connected to each other. And what happens to one can ripple out and affect others.
Okay, yeah, I'm starting to see how all these different pieces of the puzzle fit together. So for our listeners out there, what's like, the biggest takeaway here? What should they be thinking about when they're trying to decide where to put their money?
I think the most important thing is to not get tunnel vision, right? Don't just stare at a company's earnings reports or their dividend yield without looking at anything else.
Right.
Take a step back and try to see the bigger picture. What's going on with interest rates? How's inflation doing? What are people saying about the economy? All those things can really impact how well your investments do.
It really is like a puzzle, huh?
Yeah, you got to look at all the pieces, not just one or two. Each company is just one piece of the puzzle, and the economy is like the frame that holds it all together. You got to understand how those pieces fit together if you want to make smart choices about where you put your money.
Exactly. And tools like www.lokitools.net are super helpful with that. They provide that broader context, showing you how those big economic trends and those ESG factors, the environmental, social, and governance stuff can all play a role in how a company performs over the long term. It's all about making smart choices that are good for your wallet and good for the world too. That makes a lot of sense. So we've talked about individual companies, we've talked about how businesses are all connected, and we've talked about the bigger economic picture.
Yeah.
But how can our listeners actually put all this knowledge to work? Like, how can they stay on top of everything that's happening and make sense of all the financial news and data that's out there? And how can they figure out if a company is really committed to sustainability and doing things the right way?
Those are great questions, and they lead us perfectly into the final part of our deep dive.
Okay, so we've really dug into Walmart and Realty Income, haven't we? We've looked at their strategies, how they're different, and how all these big economic forces can affect them. But now, like, the big question is, how can you, like our listener, actually use all this to make better decisions about where to put their money?
Right, exactly. It's all about becoming a smarter investor.
Right.
Not just reading the headlines, but really getting a deeper understanding of how things work, what makes the market tick.
Yeah, but that's easier said than done, right? I mean,
Yeah.
there's just so much information out there. It can be totally overwhelming.
I know. It's easy to feel lost in a sea of data and opinions. That's why it's so important to, be choosy about where you get your information from and to really think critically about everything you read and hear.
Okay, so let's talk about sources first. Like, where can people go to get good information and analysis, without drowning in jargon or getting hit with a bunch of biased opinions?
Well, there are some really great financial publications out there, the ones that have been around for a while and have a good track record. They're usually a safe bet. Just try to avoid the ones that try to make everything sound super dramatic or overly simple, because finance is rarely either of those things.
That makes sense. And what about developing that critical mindset you were talking about? What does that actually look like when you're like reading an article or listening to a financial podcast?
It's all about asking questions. Don't just take everything at face value. Dig deeper. Ask yourself, who's saying this? Why are they saying it? Are they giving me the whole story, or are they leaving something out? Like, if you're reading an article that's all about how amazing a company is doing, stop and ask yourself, okay, but are there any risks? What could go wrong?
So it's kind of like being a detective, right? You got to
Mhm.
look for clues and piece everything together to see the whole picture.
Exactly. And remember, in the financial world, there are always going to be different opinions. What one expert sees as a great opportunity, another might see as a huge risk. So it's your job to weigh the evidence, listen to different arguments, and then decide what you think.
Yeah, that makes a lot of sense.
Mm.
It's not about just blindly following someone else's advice. It's about learning how to think for yourself, doing your own research, and making choices that are right for you.
Exactly. And luckily, there are some really great tools and resources out there that can help you do just that. Websites that provide in-depth analyses of companies, that break down economic trends, and even look at a company's sustainability practices.
Oh, totally. And that reminds me, we were talking about www.lookatools.net earlier from L Impact Solutions. They're a great example of a resource that can help you really dig into those ESG factors, the environmental, social, and governance stuff.
Yeah.
It's more important than ever to understand a company's commitment to sustainability, right?
For sure. L Impact Solutions does a fantastic job of connecting the dots between a company's sustainability practices and their long-term performance. It's not just about making money, it's about making a positive impact too.
Absolutely. So as we wrap up this deep dive into Walmart and Realty Income, I'm curious, what are your biggest takeaways? Like, what stands out to you about these two companies now that we've looked at them from all these different angles?
Hmm. Well, for me, it's really fascinating how they represent two totally different approaches to risk and reward. Walmart is all about growth, pushing the boundaries, expanding. And that can lead to big rewards, but it also comes with more volatility. They're like a speedboat zipping around on choppy water.
Okay, I like that analogy. And what about Realty Income? What's their vibe?
They're more like a big, steady cruise ship. They're all about consistency and stability with their net lease model, their diverse portfolio, and their focus on those juicy dividends. They're not trying to get rich quick. They're in it for the long haul.
So it really comes down to what kind of investor you are, right?
Yeah.
Are you drawn to the excitement of the speedboat, the potential for big wins but with more risk? Or do you prefer the smoother ride of the cruise ship, knowing you'll get where you're going eventually, even if it takes a bit longer? I guess that's the question we're leaving our listeners with today. Knowing what we know now, which approach resonates more with you? Are you a Walmart investor or a Realty Income investor?
And remember, this deep dive has just been a starting point. There's a whole world of investing out there to explore. So keep learning, keep asking questions, and don't be afraid to challenge the conventional wisdom. The more you know, the better equipped you'll be to make smart choices with your money. And hey, don't forget about those awesome resources like www.lokitools.net. They can really help you level up your investment game and make sure you're investing in a way that aligns with your values.
Couldn't have said it better myself. Knowledge is power, especially when it comes to your finances. So keep learning, keep exploring, and most importantly, have fun along the way. That's all for this episode of The Deep Dive. Thanks for joining us.